Okay, so we are back. I have no idea what just happened a second ago. I was live, things became really pixelated. I wasn't sure if you guys could hear me or see me. So we had to delete that previous live and we will start again. So today's topic is investing does not have to be complicated. And this is a topic that's relevant whether you are new to investing or if you have been investing for a really long time. Investing in itself does not have to be complicated. Now, if you are a day trader or you have the time and resources to make investing more complicated with fancy charts and graphs, great, fantastic. But if you're just the average person who has a 401k, an IRA, and you're just trying to build wealth for yourself and your family, you can keep things really simple and still be successful. So the three things you want to be mindful of as you are starting or continuing your investing journey is one, you want to understand your budget. Two, your risk tolerance. And three, what kind of assets do you want to keep or add to your portfolio? Let's first talk about your budget. The budget part is, of course, is the most slipperiest slope you're going to have as an investor because for most people, they tend to overcommit and under deliver. What do I mean by that? What I mean is people will, in their mind, have this budget in their head and it sounds like a great number. It sounds reasonable, they can do it. But as they put things in place and start to execute said budget, they realize over time, oh, I really can't do this. It's either they're putting money in and having to take money out because they need that money to pay their everyday bills and expenses, or they have to stop investing altogether because of their other financial commitments. So, that being said, you are better off keeping the number small until you can see whether or not this number is realistic. And that's the important word we want to focus on when creating these budgets is realistic. What can you do consistently over a long period of time? And to your surprise, that number might be lower than what you initially thought. But over time, you can make adjustments and increase. Now, you can start small and work on this for 3 months, 6 months, a year. And once you see, okay, this budget, it feels good, it's realistic, I'm able to commit to this, then you can see, well, can I increase my monthly or whatever cadence you're doing, your contributions? So the realistic part is important because you want to be able to invest consistently because that's where all of the magic happens. That's where the wealth building happens. And that's what makes investing kind of boring over time. Once you're just putting this money in, it's going where it needs to go, and things are kind of doing what they need to do, there's not much for you to do besides monitor and make adjustments along the way. And that's one thing that I believe kind of makes investing, how to put it, people aren't as excited about it once they've been doing it for a long time because after a while, you begin to understand how the market works. You understand your needs as an investor. You understand your risk tolerance, and you kind of go along this path. And over time, it can become a little mundane unless you start to change things up. And we can talk about that later or in the future live. But for the most part, once you can kind of get through that learning curve, investing does become kind of boring. And that's okay. The money is still being made. So let's not think it has to be exciting and overzealous over time. It just needs to work. And the consistency is what's going to get you there. So once you decided on your budget, the next thing is your risk tolerance. And this part is, of course, super important because it will dictate what things you invest in and what things you will avoid. Now, if you are going to invest, you must have some kind of risk tolerance. There's no such thing as a no risk asset, right? Whatever, anything you invest in, there is always going to be a chance you're going to lose money. Now, of course, every asset looks different. With some assets, there's a very smaller chance you're going to lose money, whereas others, there's a very high chance you're going to lose money. But just know once you're taking money out of savings and putting it in something, whether it's a stock, a business, crypto, whatever you're putting that money into, there is going to be risk associated with that. And that kind of goes back to the budget part. We are not gambling at the casino, right? You're not going to put all of your money like on black and hope for the best, right? You're taking strategic moves and making educated decisions and in hopes that it's going to pay off in the long run. So you don't want to find yourself in a situation where you're desperate and you're making these very outlandish decisions in hopes that something hits or takes off and you make all kinds of money, because that's not sustainable, one, and two, at some point you're going to lose money if that's your approach. So we need to, again, think about our risk tolerance and move accordingly. So if you're someone who doesn't like to lose money and you aren't comfortable with high risk assets, there's nothing wrong with that. So if you're more of a slow and steady pace kind of person, that's perfectly fine. So what does that mean for you? That will mean you're going to invest in more, I hate to use the word stable because there aren't any stable stocks, for example, but you're going to stick with things that you know kind of work, right? So you might stick with stocks that pay dividends. So that way, you know these companies have a healthy cash balance, right? Because they're able to pay dividends. They more than likely have been around 15, 20 plus years. So they know that they're pretty stable when it comes to being a business. And two to three, they have the resources to pay out money. So you know that every month, every quarter, every year, you're going to receive some kind of cash flow from this investment. And then the stock itself, for the most part, it's most companies, they're not going to go bankrupt tomorrow. The stock itself will have value. Also, you may want to invest in gold, right? Gold is that safe haven that many investors turn to in times of uncertainty. So that might be something you may also want to add to your portfolio. Now, it's a bit more expensive to invest in gold, but you know that with this investment, you're not going to lose any money, right? You know it's going to always have value. If you do need to sell it for some reason, it's very liquid. You can easily sell it, and it has value all over the world. So those are things you might gravitate more towards if you are someone who doesn't like to take a lot of risk. You may also want to invest in bonds, right? So with bonds, you know that you're going to receive your payments on whatever cadence they're paying out that to you. So those are more stable, steadfast investments. Now, if you're someone who doesn't mind taking a lot of risk, well, then for you, the possibilities are endless, right? So you can invest in real estate, you can invest in crypto, you can invest in startups, you can invest in IPOs, right? Companies that were once private, they're now going public. And whenever there's an IPO, there's always lots of PR around it, lots of excitement. But over time, things tend to balance off. But again, these are companies that you're taking a chance on because they're new to the market. You're now seeing their financial statements and you don't know what the future may hold for this company. But if you can invest in early, it may pay off for you in the long run. So those are the big differences when it comes to your risk tolerance. And for some of you, or most of you, might be somewhere in the middle. And truthfully, if you are someone who doesn't like to take a lot of risk, you need to let me not say it like that. Let me take a pause. So if risk is something that scares you, totally understand that. One approach you can take when it comes to investing is to allocate a piece of your budget each month, each quarter, etc., to riskier investments. So you can take 90% of your monthly budget and put it towards the things that you know are going to do well. They're paying dividends. You feel comfortable in these investments, and you then can take that small 5 or 10% and put it in more riskier assets just to see how things play out, right? And this is the one thing with investing. A lot of it is trial and error, right? There is no playbook. There are, of course, trends that you tend to see in the market. There are things that are more than likely going to happen in certain scenarios, right? So we know there are certain fundamentals that tend to be true or hold true, but no one knows how any of this is ever going to go, right? We're all making essentially educated guesses. So if with this 5 or 10% of your portfolio, that could be your testing to kind of get your feet wet in the water to see, well, what is it like to invest in crypto? Just giving an example. What is it like to invest in companies that have more of an international presence or to invest in a foreign company. And then with that small percentage, you can kind of just see how it goes, see how it works, see if it's making you money, see if it's losing you money. And then over time, it might help you expand and broaden your horizon. Just an approach you can think of using. It does never has to be all or nothing when it comes to investing. And this approach holds true for anyone, whether you're new to investing or if you've been doing this for a long time. Whenever you're doing something different from your norm or status quo, this testing can be the approach you can use, again, to see how things play out. Now, this could apply when it comes to investing in a new asset. So let's say you're always investing in stocks. Maybe now you want to pivot and try index funds or mutual funds, or maybe you want to try REITs, which are real estate investment trusts, or you may want to try things like crypto, or you may want to try something like gold. So this is how you can start to branch off just a little. And again, just see how it plays out. For a lot of people, it's the fear and uncertainty that kind of gets in the way of them trying something new. This also applies to new industries. So if you're someone who never thought to invest in AI, you could take this testing approach and just see how it works out for you. If it doesn't work out well, you didn't put too much money into it, no harm, no foul. But if it is going well, you may feel more comfortable putting more money into this new thing that you're going to try. So we have to just be more fluid in our thoughts. And I think for a lot of people, when you approach investing in that way, you will find that it will make things a lot easier. I like to promote keeping things simple, and you can, how to say it, keeping things simple and not overwhelming yourself, because that's the other piece that kind of gets in the way of people investing and investing successfully. When you think of investing, for many people, it causes anxiety, it causes stress. They're like, I don't know this stuff, I didn't learn this stuff, I don't know where to start. Or if you are already investing, some of your anxiety might be, well, you feel the pressure of trying to find the right thing to put your money into. You could be doing this for a really long time, but people tend to always be on the hunt for the next big thing, the next hot thing, the next money maker. And so with that added pressure, it can kind of make things overly complicated when it really doesn't have to be. So having these so we talk about budget, risk tolerance, then we talk about assets. So when it comes to assets, you must decide where you want to put your money. That kind of goes hand in hand with the risk tolerance. If you're okay with investing in more riskier things, great. You can try things like crypto, real estate, etc. If not, we go to the example that, like we just mentioned, stocks, bonds, etc. But the most important thing once you do make these decisions is to have your investor checklist. I have said this time and time and time again. I will continue to say this. This investor checklist is going to really make things super simple for you as an investor. Now, if you never heard of this before, I like to call the investor checklist just a way to have 3 to 5 metrics that you're looking for before you make a decision on an investment. So we'll just use stocks as an example, and that's the one that most people tend to invest in. So when you're looking at a new stock, a new company, a new index fund, what have you, many times you might not be sure whether it's good or not. And also, how do you know? Now, the how and the why will look different for everyone because all of our needs look different as well. But regardless, if you have this checklist, you're just kind of like, check the boxes. If this investment checks all of your boxes, great, you move forward. If it doesn't, it might mean you don't invest in it right now and you'll kind of wait to see what happens in the future, or it might be a complete no. So some things you could have on your investor checklist when it comes to stock specifically, it could be, well, does this stock pay dividends? Yes or no, right? You could also have things like, well, what industry is this company in? And am I comfortable investing in this industry? Something as simple as that. You can also take it a little bit further to say, well, you could look at their revenue performance, say, well, has this company what has been the revenue trend in the last 3 to 5 years? Maybe for you as an investor, you want to see continual revenue growth quarter over quarter. That could be a thing. Or you might say, I want to see that this company has either a steady or increased cash balance on their balance sheet. And so, whatever these metrics are, you must decide 3 to 5 things. You can keep your list pretty simple, pretty short, pretty sweet. And then, when you do have a new investment in front of you, it makes it really easy to make the investment. Now, what you put on this checklist will look different from person to person. And this is where having some knowledge will help you. But wherever you are right now in your journey, you can create your investor checklist. So if you're now starting out, you might say, well, I need to know what this company does, period. I must use their service or product. And 3, I must, how expensive or cheap is the stock, right? Those might be your 3 requirements just starting out of the gate. Again, simple. So now you have this stock in front of you. You can check each box. If it meets it, great. If it doesn't, you move on. But do you see how that can now take something that could be really overwhelming and complicated, and it makes it super simple? And the great thing about your investor checklist is you can change it as you go. So as you become more knowledgeable as an investor, as you become more sophisticated as an investor, or as your needs and wants change, your list can change as well. And as long as you have this list either written down on a piece of paper or if it's just a mental checklist, whatever works for you, but having that in front of you or in your mind will make things going forward super simple. You don't have to overthink, overanalyze. You have these metrics that, that you're looking for. If this stock meets those requirements, great, fantastic. If not, again, you move on. And now you can invest with more confidence, and this will help alleviate your stress. Now, if you are looking for a way to develop your investor checklist, I do have my ebook, and I do have it linked in the caption down below. My ebook is called Stock Market Investing for Beginners. Now, in this ebook, I do teach you about investing in a way that's really simple and really easy to understand. I do give you terminologies that you will tend to hear a lot as an investor. Some of you may have heard, have no idea what they are. Well, in this ebook, it breaks it down so you can have these definitions, and I try to keep it so the average person can understand it. I know when it comes to lingo in any industry, that tends to make things really intimidating. So, for example, when you talk to your lawyer, your doctor, or a nurse, right, they have their own way of speaking. And if you're a non-person in that industry, you're like, what are you saying? Right? And I know in finance, it goes the same way. So when I'm in a boardroom on a conference call and it's all finance people, we're all speaking the same language essentially. But if you were to throw someone in there from like engineering, they might be in that call and they have no clue what we're talking about. And so I'm very mindful of that whenever I'm creating things like an ebook, presentation, one-on-one coaching with clients. I want to make sure it's easy for you to understand so you're not overwhelmed and you won't just turn your brain off. Right. So in this ebook, I do keep it really, really simple. But again, I do have it linked down below. And in this ebook, we do talk about how to start to create your investor checklist. So feel free to check that out. If you do have any questions, you can send me a DM on Instagram, or you can put your question in the caption down below. So pivoting just slightly because it is Monday, June 23rd, and there has been a lot going on in the last couple of days with the war overseas. And I know a lot of people are very anxious right now. But one thing I will say, I did put a post on my social media last night, I want to say. The stock market is going to respond to what is happening right now. And more than likely, we are going to see dips and decreases in the market. So with that being said, now is not the time to start panicking. And now is not the time to start panic selling. You really do have to kind of stay calm, stay level headed, and more importantly, look at this as an opportunity to buy certain things on sale now. Because the stock market, many industries are going to take a hit, but there will be industries that will do well, right? So if you open your 401k today, or your IRA today, or at some point this week, and you begin to see red and you're losing money, just know that is what's going to happen. And that's what happens in times of war and uncertainty. And unfortunately, we've kind of already been in this weird space, particularly here in the US, with the tariff conversation, the new administration. The market has already had lots of bumps and bruises coming into the new year. And we were finally starting to see the market rebound in the last few weeks. But with this new event and occurrence, it's going to probably go back down again. So don't be surprised, but also just brace yourself and don't get caught up in the sky is falling narrative that the media is going to project. Now, war in itself, we're moving that aside. Like that's a thing, very treacherous, very dangerous for all parties involved. And that's here, right? But on this side, we're talking about just finances and money and how this will impact your 401k, your IRA, or any other investments you might have. Now is not the time to be overly emotional and start just making rash decisions. This is par for the course as an investor. And as I've said in the past, when the market takes a dip or when it takes a hit, that is the time to look at this as a Black Friday sale. So while everyone else is panicking and panic selling, or they're completely not investing at all, this could be your opportunity to find things at a really good price. And this is what we talk about as far as doing the opposite of what everyone else is doing. And that part definitely is counterintuitive to what feels natural in times like this. And also it may be against what other people in your circle are doing, but we've seen this time and time and time again. When the market hits, it's going to rebound, or when the market takes a dip, it is going to rebound at some point. Now, when and how, no one has the answer to that, but history shows it does bounce back eventually. And so for you, if you can invest in certain assets when they're at a cheaper price, when the market bounces back, that's when you will see the financial benefit. But that, in order to see that, it requires you to, you're taking a chance, right? So there's that. But two, you have to stay committed to your financial journey. And that is what's going to separate the regular average investor from a great investor. And it's not always about how much money you're putting into the market. It's your consistency, your commitment, and the strategic moves that you are making. So more to come this week as things progress, as things come out. I will, of course, either post a video or I will go live again. But now, again, is a time for us all to start paying attention even more so to what's going on right now. And what makes this even worse, that we've already in a place in a time of high inflation, unemployment is increasing, job insecurity, food insecurity, housing insecurity, a new administration. Now, to add on top of all of that stuff, now we have a war, another war overseas. So there are going to be tough times ahead. And unfortunately, the job market that's already tough may only get even tougher. A time where inflation is already high, things are going to get more expensive. And not only just due to the tariffs, right? It's going to be due to everything that's going on overseas. The price of gas and oil is going up. I think it was up 3 or 5% as of yesterday. And that was before trading day open today. I'm sure it's even higher now. And so when the prices of things like oil and gas increase, it trickles into everything else that we use. Flights, anything that requires production, shipping, right? All of those industries are going to be impacted as well. And what that means is the price of goods and services are going to increase as well, on top of things that are already inflated when it comes to price. So we all must brace ourselves. I definitely don't want to be all doom and gloom, but just know things that we are going to have a rocky road for the next few months, if not for the next year, in my opinion, if not longer, but definitely for the foreseeable future, the next 6 to 12 months, it's going to be rough. So with that being said, if you have any comments or questions on today's live, put them in the chat down below, and I will see you guys in the next live. Take care.